Today we're back in our Breaking Down the One Big Beautiful Bill series, and we're talking about the key changes to the real estate industry. This law makes permanent several key provisions from the 2017 Tax Cuts and Jobs Act and introduces new opportunities for businesses, investors, and developers. One of the biggest changes is the return to a more generous business interest deduction formula. Interest deductions are once again limited to 30% of the adjusted taxable income base, or the EBITDA calculation, meaning depreciation and amortization are now added back into the base amount. This effectively allows more interest to be deducted. However, the law removes the ability to capitalize interest to get around the deduction limits and excludes some income from foreign subsidiaries in the calculation, which could affect companies with overseas operations. These rules are permanent and most likely take effect starting in 2026, with the EBITDA change effective for tax years beginning in 2025. The bill also introduces a new 100% expansion option for certain non-residential real estate uses in qualified production activities like manufacturing and agricultural production. Construction must begin after January 19, 2025 and be completed by 2031. Bonus depreciation is back. The law permanently restores 100% depreciation for qualified property acquired and placed in service after January 19, 2025. That includes most tangible personal properties with a useful life of 20 years or less. Another key win, the 20% qualified business income deduction under Section 199A is now permanent. This applies to partnerships, S-corps, sole proprietors, REITs, dividends, and publicly traded partnerships. Originally set to expire after 2025, this deduction remains locked in moving forward. For REITs, there's another benefit. The cap on how much a REIT can own in a taxable REIT subsidiary goes from 20% to 25%, effective in 2026. Opportunity zones also got a major boost. The OZ program is now permanent. New zones will be designed every 10 years starting in July of 2026. Capital gains investment into opportunity zones after 2026 can be deferred for 5 years. Investors who hold the OZ investment for at least 5 years get a 10% step up in basis, or 30% if the OZ is in a rural area. After 10 years, any gains can be fully excluded. There are new reporting and compliance rules for these funds as well. A new benefit has been added to lenders too. Regulated lenders can exclude 25% of interest income earned from loans secured by rural agricultural real estate to qualify. The loan must be made after July 4th, 2025 and not to be refinanced of an older loan. Developers also get help through permanent changes to real estate tax credits. The new market tax credit is now permanent, and the 9% low-income housing tax credit is also being expanded. The 4% LIHTC will be easier to claim due to the relaxed bond financing rules, and these changes are expected to lead to more affordable housing and community development projects starting in 2026. Notably, the final bill did not include the controversial revenge tax under proposed Section 899. That measure would have imposed higher withholding taxes on companies based on countries with discriminatory tax practices against the U.S. firms. Also left out any changes to the tax treatment of carried interest, despite earlier efforts to reform them. More details, guidance from the IRS and Treasury is expected soon. But for now, real estate investors and developers can begin planning around these new rules.